Dear listeners, today we will examine one of the greatest paradoxes of the financial world in the finest detail, the mysterious and surprisingly parallel relationship between the world's wealthiest investor, Warren Buffett, and technical analysis. Throughout this podcast, you will see how Buffett, whom many of you know simply as an old man who doesn't read charts, is actually a massive system designer, and how his value-oriented approach aligns perfectly with technical terms in the modern trading world. Put on your headphones and lean back, because today we are going to shake the Buffett image you think you know. Warren Buffett is not a trader in the classical sense. You won't find candlestick charts, complex trend lines, RSI fluctuations, or MACD crossovers on his desk. In fact, he has made some quite harsh jokes about charts in the past. When Buffett rejects technical analysis, he bases it on a very fundamental and unshakable logic. He says that charts look at the past, while value looks at the future. A chart tells you what happened yesterday and where the price came from. However, investing means predicting what will happen tomorrow. For Buffett, a stock price is not just a piece of paper or a flashing digital number on a screen. It is a partnership share in a living, breathing, product-producing, and cash flow-generating business. That is why his core philosophy is built on business action, not price action. In other words, he is interested in the mathematics of the company, not the geometry of the price. So why does Buffett exclude technical analysis so harshly? Because, in his view, the market is there to serve you, not to guide you. Many traders who use technical analysis perceive market signals as instructions. They buy when a resistance is broken and sell when a support is broken. In other words, they submit to the market. For Buffett, however, the market is Mr. Market, a character he inherited from Benjamin Graham, who comes to your door every day and offers you a price for the goods he holds. Sometimes Mr. Market is very cheerful and asks for a price far above value. Other times he is very depressed and tries to sell wonderful assets for next to nothing. This is exactly where Buffett's difference lies. He does not let the market tell him what to do. Instead, he watches for the emotional mistakes the market makes. However, we must emphasize a critical point, perhaps the most overlooked one. Buffett does not actually stand at a pole completely opposite to technical analysis. He simply uses the same concepts in a different dimension and with different terminology. We can call his approach pseudo-technical analysis. For example, sentiment analysis, or market psychology, is actually Buffett's greatest strategic weapon. His world-famous quote, "Be greedy when others are fearful, and fearful when others are greedy," is the simplest and most effective summary of contrarian trading in financial history. When a stock price crashes and everyone sells in a panic, Buffett's move to buy is based on the same psychological foundation as a technical analyst looking for a reversal signal in an oversold zone. Buffett doesn't look at the chart, but he reads the market's mood, that sentiment, in its purest form. What carried Buffett to the top of the markets is actually a massive strategic advantage consisting of 5 main layers. When we translate these advantages into technical analysis language, a magnificent table of similarities emerges. The first layer is the value edge. Just as we look for a discount zone or a demand zone in technical analysis, Buffett calculates the intrinsic value of the company. If the market price is well below this real value, this is the strongest buy signal in the technical world for him. The second layer is the time edge. While short-term traders fight with market noise in minute or hourly charts, Buffett eliminates uncertainty by using the power of time. For him, time is the greatest ally that reduces risk and increases certainty. The third layer, the behavior edge, is entirely about psychological discipline. Even if you have the best strategy in the world in technical analysis, you will lose if you cannot manage your emotions. Buffett's greatest advantage in the market is that his emotions are not affected by price movements. The fourth layer is the filter edge. Buffett does not get involved with every stock or every sector. He only chooses companies he understands, whose cash flow is predictable and strong. This is exactly the same discipline as a professional technical analyst, not jumping on every chart, but waiting only for their own A-plus setup. Finally, with the positioning edge, he makes few but meaningful trades. Instead of dozens of small positions, he opens massive positions in a few assets he trusts most. In technical language, we call this high-conviction position sizing. When we examine Buffett's system more deeply, we see that he does not buy a stock, but actually a system. The analysis process begins with understanding how the business makes money. This is where the moat concept comes into play. An economic moat is the sustainable competitive advantage a company has against its rivals. For a technical analyst, this is like a strategic support level with concrete poured under the price. If a company has a strong brand, a low-cost structure, or high customer loyalty, that company's financial uptrend cannot be easily broken. For Buffett, if there is no moat, the trend is unsustainable. In other words, he doesn't just look at the trend line on the chart, he looks at the fortress that keeps that line there. Regarding financial filters, Buffett acts almost like a set of indicators. Return on equity, ROE, is a momentum indicator for him. Net profit margin is a kind of volume indicator showing the company's strength. Free cash flow is the fuel of the system. When Buffett looks at debt ratios, he is actually measuring the company's leverage risk. Just as excessive leverage can blow up an account in technical analysis, excessive debt on a company's balance sheet can blow up that company's future. That's why Buffett actually creates his own safe trading zone by filtering for low debt and high cash generating companies. Buffett also breaks the mold regarding the definition of risk. Classical finance theory and the world of technical analysis usually measure risk with volatility, i.e., how sharply the price fluctuates. Buffett strongly opposes this. According to him, risk is not the price going up and down, but not knowing what you are doing. If you have miscalculated the value of an asset or invested in something you don't understand, you are at risk even if the price doesn't fluctuate at all. This perspective acts as a massive shield protecting the investor from temporary price shocks and short-term stop-loss hunting. So, what is the ultimate, almost magic-like power that makes Buffett so successful? The answer is simple, but the hardest thing in the world to implement: compounding. Buffett became one of the world's richest people by consistently maintaining returns of 15 to 20% annually, which may not seem miraculous to a trader, for 50-60 years. Instead of paying commissions to brokers and taxes to the state by trading frequently, he let that massive snowball of profit upon profit roll down the hill. In this process, time works better than even the most complex indicator. In this part of our podcast, let's translate Buffett's system into modern trading language like a full glossary. Buffett's intrinsic value is our fair value zone. His margin of safety is our predetermined risk-reward ratio. Those moments of panic where the price moves far away from the value are capitulation zones for us. Buffett's discipline of being selective is our selective trading approach. As you can see, dear listeners, although the names change, the mathematics and psychology of success never change. Many people fall into the trap of thinking, Buffett doesn't know technical analysis, that's why he doesn't use it. This is absolutely wrong. Buffett knows technical analysis. He even tried these methods, which were very popular at the time, at the very beginning of his career. However, he chose to play his game in a different arena. Technical analysis is a timing game. Buffett's game is a value game. While the trader tries to predict where the price will go, Buffett waits with great patience for the moment the price is wrong. The difference is like one person trying to predict the wind, while the other waits for the moment the wind blows from the wrong direction to pull their ship into the harbor at the lowest cost. In conclusion, the secret of Warren Buffett's success is neither luck nor complex algorithms or secret formulas. His success comes from correct filters, unwavering discipline, and the ability to completely silence the noise of the market. Buffett teaches us this. You don't need the fastest computer or the most expensive charting software to beat the market. What you need is to stay true to your own valuation system and not form an emotional bond with those sometimes ridiculous, sometimes rational price offers Mr. Market presents to you every day. If you take only one sentence from what you heard today, let it be this. A trader predicts where the price will go, but a successful investor waits for the moment the price is wrong. When you start to see the market not as a guide, but as a servant, that is, when you wait for value to come to you instead of chasing price, you will have leveled up in your financial journey. This is exactly what Warren Buffett has been doing for half a century. He did not read the cold lines on the charts, but the human psychology and the concrete realities of the business world that created those lines. What we have discussed is not just investment advice. It is a profound transformation of mindset. Whether you use technical analysis or fundamental analysis, if there is no discipline, no filter, and no margin of safety in your system, you are destined to be lost among the market's rough waves. Buffett's way is actually the simplest way, but for human nature, the simplest is always the hardest. Patience, discipline, and correct asset selection. These are the 3 keys to financial success, and Buffett has held these keys with great mastery for over 90 years. I hope this comprehensive analysis has brought a new breath and a different perspective to your investment strategies. Remember, being fast in the market can sometimes win, but being right always wins. I wish you profitable and peaceful days where you can see the real value beyond the charts, silence the market noise, and focus only on your system's signal. Thank you for listening. See you in the next episode.